not a SEBI registered investment advisor, and the material given is only for educational purposes. This video is just for the educational purpose. Before making any investment decision, please consult your qualified investment advisor. The thoughts and ideas presented in this video are strictly our perspective. The content about any company in the following video are not any recommendation to buy or sell.
Hello everyone, myself Pratham Jariwala.
Hello, myself Shreyansh Baradia.
Myself, Aryan Vakela.
Hello, I am Anuj.
Myself, Gaurav Bothra.
So, we are here to present you our understanding on FMCG industry. FMCG is an abbreviation for fast moving consumer goods. These are the products that are sold swiftly at a variety of prices and are intended for a daily or regular consumption.
FMCG products includes many categories such as food and beverages, beauty and personal care, household cleaning products, and many others.
With a vast consumer base of 1.4 billion people, Indian FMCG industry is one of the fastest growing industries.
The growth of middle class population in India is one of the major forces driving the FMCG businesses. Considering the rising discretionary income, FMCG items are often mass produced and have a short shelf life. They are distributed to a variety of outlets including supermarkets, hypermarkets, convenience shops, and online platforms.
FMCG companies typically focus on building a strong brand and building loyalty among consumers to maintain market share in a highly competitive market. The vast diversity of Indian population is one of the major issues confronting the Indian FMCG business. India is a big nation with many different cultures, languages, and tastes. To meet the different demands and tastes of the Indian people, FMCG companies must adapt their products and marketing strategies.
So, before moving forward towards the video, we need to make clear to our viewers that we were inspired after reading the book named The CEO Factory by Sudhir Sitapati sir. Sudhir Sitapati sir was an executive director and the vice president at Hindustan Unilever in Food and Refreshment Department, and he is currently the managing director and CEO at Godrej Consumer Products Limited. So, based on our understanding of the principles underlined in this book, we have created a checklist of how to analyze an FMCG business. But before moving forward towards the video, we need to give you a gist of our background that we are the students of Pinnacle Institute and we are currently pursuing FinBridge program from Pinnacle and also BCom from our university.
Okay guys, let's get started with the discussion for today, and our first point of discussion is mindshare. So what exactly is mindshare? As I've written here, mindshare refers to the level of consumer awareness or recognition of a particular product, brand, or company in the marketplace. This data is important to track in FMCG companies as they are highly competitive, and to build a competitive advantage in such businesses, it is necessary to have a higher mindshare. And as the saying goes, mindshare drives market share. Now, what's market share? Market share to break down market share easily, I'll give out a simple example. If 100 packs of biscuits are being sold in an year, and a market player in that industry holds 60% of the market share, so it means that out of those 100 packets of biscuits, 60 packets of biscuits are sold by that company alone. So we can here we can conclude that mindshare drives market share, which drives sales. Now, what do the companies do to increase or maintain their mindshare? As I've written here, companies often invest heavily in advertising, branding, and other marketing efforts to increase their mindshare and establish themselves as leader in their respective industries. So, in building mindshare or increasing mindshare, the main goal here is to become market leaders in their respective industries. So, to conclude this slide, mindshare is wholly dependent on consumer preferences. And to know consumer preferences better, we conducted a small survey. Now, as I mentioned earlier, consumer preferences are based on mindshare and the brand image that the product has in the marketplace. But can mindshare be calculated? Is the real question. No, it cannot be quantified, but mindshare of a product can be judged through such surveys. So what we have tried to do here is to point out the brands in a category which have the highest mindshare, that is consumer preference. We have just plotted those in a pie chart. And I'll also attach the link of this forms in the description box. And we know that sample space plays an important role in such surveys, and the reality might be a lot different than these results. But what we have tried to do here is just to portray a way of calculating mindshare. Okay, so now that we are done with mindshare, we can move on to our next topic, that is brand equity. So what exactly is brand equity? What I've written here is brand equity refers to the value that a brand adds to a product or service beyond its functional benefits. It is the perceived value that a brand holds in the mind of consumers. To put it into simple words, the real question to ask here is, why is a product able to charge more than its competitors, engaging in the same industries and still maintaining its market share? The answer is its brand equity. Brand equity mainly consists of 5 points: brand awareness, brand association, perceived quality, brand loyalty, and brand identity. We have tried to quantify, not quantify, but to give out an example on how we can go about analyzing brand equity by using the survey which we conducted. So let me just open the file. So basically, this is the category, and these are the standings. This is the product, and these are the companies which manufacture the product. So as we go down, we can see the standings of categories ranking from 1 to 5. Now, how can we compute brand equity or go about analyzing brand equity through this information? What I've done here is I have segregated companies which have more than one product in the top 5 rankings in all the categories. So we have Hindustan Unilever with number 1 product Surf Excel from detergent category, Rin from detergent category again, Pepsodent from toothpaste, Dove from soap, Pierce from soap, Lux from soap category, Dove which is number 1, which is also number 1 in the shampoo category, Sunsilk which is also from the shampoo category, Tresemme, Clinic Plus, Brook Bond from the tea category, Tajmel from the tea category, and Brew from the coffee category. Similarly, we have Marico and Procter & Gamble, which is P&G, in Tide, Ariel, and Head and Shoulders, shampoo category. We also have Coca-Cola with top 4 out of 5 standings in aerated drinks, and we have Dabur with Meswak and Dabur toothpaste from toothpaste category. Here we can conclude that the companies which have top 5 products with high mind shares will have higher brand equity than their competitors.
Revenue and market share. In FMCG business, we normally analyze the revenue of a company over 2 year, 5 year, 10 year, etc. But it is also important to analyze revenue along with market share. What is market share? Market share is basically revenue of company divided by total revenue in which company operates. So in FMCG business, it is important to analyze the revenue along with market share, which gives the basic idea about dominant position of company in an industry. One important checkpoint should keep in mind while analyzing revenue, that is, revenue should grow at least rate of inflation. Revenue is the main crux which gives the basic idea about other functions like brand recognition, supply chain efficiency, advertisement, pricing, positioning, etc. Market share and revenue and growth of revenue shows the dominant position of dominant as well as competitive advantage of company in an industry. So here we have taken the dummy numbers of company XYZ, revenue figures in crores, revenue growth which is compared to which is for FY22, market share FY21, market share FY22. We can see that revenue has grown by 20% in FY22 for company X, 67 for company Y, 100% for company Z, and total revenue has increased by 50%. Market share in FY20. Market share in FY21 was 50% for company X, 30% for company Y, and company Z it was 20%. What happens in 2022? In 2022, we can see that market share of a company X has declined by 40%, although their revenue has increased by 20%. For now, let's look at a company Y and Z. In Y and Z, we can see that their revenue had also increased and their market share has also increased. What it shows? It shows that competitive advantage and dominance of the company Y and Z has increased in FY 2022 compared to the company X. So when we only analyze the revenue figure, we can see that company X revenue has been increasing, but when we add the another component, market share, we can see that company X revenue is increasing, but their total contribution in overall market has decreased. What it shows? It shows that the competitor has better product, either better quality product, or either better branding strategy, better advertisement, better supply chain, better pricing power, etc. So what it conclude? It conclude while analyzing the revenue, we should also analyze the market share as well. In FMCG business, cannot directly compare revenue of Hindustan Unilever with Dabur, with ITC, with Nestle, etc. These all companies are operating in a different segments and different categories. So, in analysis of revenue, we had to compare the particular segment or category revenue with another company's particular segment revenue. So here we have taken the data from Ambit Research Report of Jan 2022, which highlight the major categories in which HUL operates, their market size and market shares of HUL, and famous brands which contribute to this market share. First, we will start with the bar soap. Bar soap has a 36.40% market share. The major brands are Lifebuoy, Lux, Pierce, and Dove. For hair care, HUL has around 60% market share. Clinic Plus and Dove are the major brands of it. For skincare, it has around 39% market share. Fair and Lovely, Pond's are major brands. Oral care, it has around 16.30% market share. Close-up and Pepsodent are major brands. For laundry care, it has around 32.30% market share. Surf Excel, Rain are the major brand. Dishwashing category, it has around 60.30% market share. Veen and Sif are the major brand. The chart basically shows the market share of the HUL, market share of major subcategories of HUL. After analyzing revenue and market share, it is also important to analyze incremental market share. What is incremental market share? Incremental market share is nothing but increasing additional revenue of company divided by additional market share of entire industry in which company operates. Formula for incremental market share is here. Incremental revenue divided by incremental market share. Right? If a company's incremental market share, if company has incremental market share over the year, what it highlights? It basically highlights that company may able what it highlight. It basically highlights the consumer loyalty, consumer satisfaction, consumer preference towards your product. It also highlights your efforts towards advertisement, brand visibility, etc. If a company has achieved incremental market share over the year, it may be possible for the company to reduce the cost of production, improve profitability, achieve economic of scale, etc. So here we have taken the dummy numbers of company X, Y, Z, which shows the revenue figure of FY21, revenue figure of FY22. These all figures are in crores. Incremental revenue, which is nothing but revenue of 2022 minus revenue of 2021. All right. Incremental market share is increasing incremental revenue divided by incremental market share. We can see that company X has incremental market share by 20%, which shown in here. For company Y, incremental market share is 40%, which is shown here. For company Z, incremental market share is also 40%, which is shown here. So in FMCG business, it is important to analyze incremental market share of company. Like we can take an example of HUL. If HUL has market segment of 20% in FY21 and which has increased to 25% in FY2022, what it shows? It shows the company had made efforts towards advertisement, consumer reach, consumer satisfaction, consumer loyalty, consumer preference towards the product. So it is also important to analyze incremental market share along with revenue and market share.
Let's move to our next point in our checklist. Employees' efficiency is a financial metric that measures a company's efficiency in generating revenue based on the number of employees. It is important because it can provide insights into a company's productivity, efficiency, and profitability. A high revenue per employee ratio is generally considered a positive indicator, as it suggests that a company is generating significant revenue with fewer employees. A low revenue per employee ratio could indicate that the company is less efficient or that there is a room for improvement in terms of revenue generation. Revenue per employee ratio can vary widely by industry, so it is important to compare a company's ratio to those of similar companies in the same industry. For example, technology companies generally have higher revenue per employee ratio than retail companies due to difference in business models. While the revenue per employee ratio can be a useful metric for assessing productivity and efficiency, it has some limitations. For example, it does not take into account the quality of revenue generated or the level of expertise required for different roles within the company. The formula for employee efficiency is revenue from operations divided by total number of employees. Here is the graph showing revenue per employee of Dabur and HUL, the data we have collected from annual report of respective companies.
Now let's move on to our next point for today, which is anchor product. So basically, what's an anchor product? So an anchor product is like a key product or a flagship product of a company, which means it is the core business. It is the core of the business. It is the heart of the business, and around which the company produces other complementary products. So basically, how it works is, like for example, in Coca-Cola, the Coca-Cola Classic is the key or the flagship product, and around which we have seen other aerated drinks developing other Coca-Cola developing other aerated drinks, and the consumer base won by Coca-Cola Classic has now been spread across the various subordinative or like the complementary products the Coca-Cola has produced around Coca-Cola Classic. So basically, these are the characteristics of anchor products. Like they differentiate themselves from competitors and establish a strong brand identity. Like obviously, the Dove moisturizing bar. After which the Dove also started engaging in various other products like Dove shampoo, Dove body wash, and all. And they have a loyal customer base, and which is then on passed on to the complementary products, which is create cross selling opportunities. Then overall anchor products can be a powerful strategy for driving growth and profitability, but require careful planning and execution to succeed. Also, it requires significant investment in R&D and marketing to establish and maintain their position in the market, which is basically the market share. So unfortunately, we could not find product level data for, but we have tried to showcase a relevant case study to anchor products. So here it is. Okay, so this is Dabur, and this is a 10-year horizon analysis of Dabur. We have punched the revenue numbers, the EBIT, which is earnings before interest and tax numbers, and CapEx, which is capital expenditure. So we could see that the consumer care business of business segment of Dabur have been generating around 84% of Dabur's total revenue throughout the 10 years. An average of, if you could see, it's 84% of Dabur's total revenue for the past 10 years have been generating from consumer care business. If we take a look at EBIT around at an average of 91%, if you could see this number, the average is 91% of Dabur's EBIT comes from consumer care business. And let's take a look at the capital expenditure. Here, around at an average of 63% of Dabur's capital expenditure goes into consumer care business. So we can conclude that this is an anchor segment of Dabur. So this was the case study that I wanted to show. Now that we have seen what does it mean by anchor products and a case study of Dabur's consumer care business, we will move on to the downside of anchor products. Yes, I'll agree that an anchor product establishes a loyal consumer base, creating cross-selling opportunities and helping to differentiate the business from competitors, but it also possesses some risks. Some of those risks are vulnerability to market shifts. Market condition, it is based on consumer preferences. What if the consumer preferences get changed and the demand for the anchor product gets reduced? So it affects the overall revenue of the company. The next one is reduced innovation. If a company is focused way too much on the anchor products, it can limit the business ability to innovate and develop new products or services, leading to a decline in competitiveness over the years. The next is limited diversification. which is overdependence on a single product, which leads to company's ability to diversify its revenue. That means the company has limited revenue streams, which means it has an overdependence on the anchor products. And the last one is increased competition. So relying on an anchor product can attract competitors who may attempt to replicate or improve upon the product, leading to an increased competition and potential market share loss. So the basis of these two slides and the case study was it is completely fine to have anchor products, but it is necessary to build the complementary products around the anchor products and to spread the loyal consumer base through cross selling and to build a brand as a whole.
Let's understand the next point of our checklist, which is research and development expenditures. What is research and development expenditure? Research and development expenditure is the expense which the company spends for researching and developing new products and improving the existing products. It involves innovation. Research and development involves researching your market and your consumer needs. With researching your market, the company is able to know their consumers better, and this will help them to develop new and improved products to fit these needs. It involves improvement in quality and reducing cost. R&D aims at improving existing products' quality by research and making it cost efficient. It tries to cut down the unwanted cost so more consumers are attracted towards the product. It involves growth. A regular R&D expenditure over a long period of time results in long-term growth and profitability. A regular expenditure over a long period of time will help the company to understand their consumers better. So this will help in making more good quality of products, and so more consumers are attracted towards the product of that company. Let's take an example of Dabur. In this chart, we can see that Dabur has regularly increased the spendings in R&D expenditure, and its R&D expenditure as a percentage of revenue is also increasing, which is a good sign. What is revenue per R&D expense? To judge a company's efficiency in R&D, we use this formula. It means how much revenue the company is generating by spending 1 rupee in R&D. Let's see the calculations. I have calculated R&D expense as a percentage of revenue by dividing R&D expense by revenue. I have calculated revenue per R&D by dividing revenue by R&D expense. To find the research and development expenditure of any company, you have to go to its annual report. In annual report, you have to go to notes to accounts of statement of profit and loss under the heading other expenses. If you didn't get there are chances that you can get in first 5-6 pages of infographics.
So, after learning how to analyze FMCG business with the metrics of research and development expenditure, let's move towards the next metrics which we will use for analyzing, that is advertising and marketing expenses. Advertising and marketing expenses play a crucial role for the success of an FMCG business because it helps to increase the brand awareness. Businesses can use advertising and marketing to raise the brand awareness and make their products more visible to the potential customers. It also helps in creating the brand loyalty, which means consumers who have had positive experiences with the brand are more likely to purchase more products from that brand in the future. Let's take an example that in washing powder, when our mothers are satisfied that this washing powder removes the dirtiest stains and has the best fragrance, they become attached to that product, and that is how loyalty gets developed. It also helps in to compete with the other competitors. That is, businesses can create a distinct brand identity and differentiate themselves from competition by investing in advertising and marketing. For example, Coca-Cola and Pepsi, they both want to get ahead of the competition in order to make people remember your product and keep existing customers loyal, as well as to attract the new customers. So let's learn how to use this matrix for analyzing an FMCG business. For that, let me first share our screen. So here in our presentation, we can see that the first point which we have taken into the consideration is revenue per marketing expense. Revenue per marketing expenses basically helps us to understand how much of the revenue can be generated by spending per rupee on the marketing. That is, let us understand this concept using the Excel data which we have punched of the two listed companies, that is HUL and Dabur India. So these are the figures for HUL and Dabur India which we have computed from the annual reports. We have found out that revenue per marketing expense by revenue dividing by marketing expenses. So we have computed the numbers for FY15 till FY22, that is financial year 15 to financial year 22. We can see that 1 rupee of the marketing expense spent by HUL is able to generate 8.1 crore of the revenue. Similarly, when we move towards the timeline to FY22, we can see that 1 rupee of the marketing expense is able to generate 11.1 crore of the revenue. So when we see the trend line, it's basically increasing. Let's move towards the Dabur India. When we see the revenue per marketing expenses of Dabur India, that 1 rupee of the marketing expense spent by Dabur India is able to generate 10.4 crores of the revenue. And when we move towards the timeline to FY22, we can see that 1 rupee of the marketing expense is able to generate 14.0, that is 14 crores of the revenue for Dabur India. So let's move towards the next point, that is CAGR comparison. CAGR basically means that compounded annual growth rate, that is by how much percentage a particular line item is growing year on year basis. Let's understand how this point is useful for us for analyzing the FMCG businesses. So here we have computed the CAGR growth of the revenue and marketing expenses as well as revenue per marketing expenses of HUL and Dabur India. Let's understand that how they are helpful for us in analyzing this business. We have computed the CAGR rate by using the rate formula in Excel. So we have computed the CAGR rate of revenue for HUL, which is 7%, and marketing expense growth rate is 3%. That is, marketing expense is growing by 3% of the CAGR and revenue expense is growing by 7% of the CAGR. So there are less efforts on the front of marketing expenses as compared to the revenue. So that revenue is growing by more percentage than the marketing expenses. That is, marketing expense is just growing by 3%. So there is a 3% of an incremental effort in the marketing expenses, which is leading towards the 7% of the growth in HUL on the front of revenue. So now let's move towards the understanding of Dabur India. Here we can see that the CAGR rate of the top line for Dabur India is 5% and marketing expense CAGR is 1%. Obviously, the revenue is growing by more percentage than of the marketing percentage. So less efforts on the front of marketing expenses is able to generate more of the revenue. This basically leads towards the limitation for the concept called marketing expenses as a percentage of revenue. So marketing expense as a percentage of revenue basically means that how much of your marketing expense constitute of the revenue. That is, here the 9.6% depicts that the marketing expense of the Dabur constitute 9.6% of the top line generated by the Dabur for that particular year. So for Dabur, we can see that the marketing expense as a percentage of revenue is in a decreasing trend. Now, one may conclude that the company is not doing much of their marketing expenses to generate more of the revenue, but this is wrong. As we have seen that the CAGR rate of revenue is more than the CAGR rate of marketing expenses, that is, revenue is growing by more faster and more greater rate than the marketing expense. So that is obvious, the marketing expense will constitute lesser part as the revenue grow by more percentage. So this graph is basically created by using the data which we have jotted down in Excel, which we have shown to you earlier. So this graph shows the growth of the revenue from FY15 to FY22, as well as this orange line shows the growth of the revenue per marketing expenses.
Let's understand the next point in our checklist, which is accessibility. It refers to how much a product is accessible to different variety of consumers. For example, let's take two men. One man belongs to a poor class and is paid on a daily basis. So he would prefer to buy a 5 ml sachet of shampoo. The second man belongs to middle class and would prefer to buy a month's quantity, and so he would prefer 1 liter bottle of shampoo. So it is important for a company to have different SKUs. SKUs. What is SKU? SKU refers to stock keeping units. In the screen, you can see there are different kinds of bottles and a sachet. This sachet of 5 ml is one SKU. This bottle of 80 ml is another SKU. This bottle of 180 ml is also another SKU. Having more number of SKUs in FMCG business improves accessibility that helps you maintain or grow market share, as it helps you reach more variety of consumers. Having more variety of SKUs will help the company to attract a wide range of consumers, and so this will lead to profitability and the growth of revenue and also the growth of market share of the company. Let's take an example of company A and company B. The company A has 6 types of SKUs, but company B offers only 3 SKUs. In this example, we can see that company A has more number of SKUs than company B. So it will help company A to capture a variety of consumers more than company B.
So let's start with the next point of our discussion, which is a shift towards organized consumer market. So to explain this point, I'll first start with explaining what are organized and unorganized marketplaces. So basically, unorganized markets are highly structured and regulated, where unorganized markets are relatively informal. Unorganized markets pricing is standardized, while in unorganized markets, prices are flexible based on supply and demand. The quality control in organized markets is very strict, whereas the quality control can be difficult to judge in unorganized markets. Next, the distribution channels are very well defined in organized markets, whereas in unorganized markets, the distribution channels are scattered. So, how does a product differentiate itself and force the unorganized consumer base to switch from unorganized products to an organized and branded products? So the first point is standardization, which is a new brand of food products can differentiate, this is an example of standardization, which is a new brand of food products can differentiate itself in an unorganized market by offering superior quality, safety standards, attractive packaging, and competitive prices. So to actually achieve a move from consumer preferences to unorganized to an organized market, the company needs to make a lot of investment in marketing, distribution, and infrastructure. And at last, launching a new product successfully can expand the organized consumer market by capturing a new consumer base. So basically, the consumer base of the unorganized market gets switched to organized market products because of their standardization, their centralization, and their distribution channels. So next up, Indian market has witnessed a shift towards organized branded products across various categories where organized players have captured a significant market share. For example, Pillsbury, Ashirwad, and Patanjali in the flour category, Bisleri and Aquafina in the bottled water category, and brands like Everest, MDH, and Catch in the spices category. So that's it for this point. Let's move on to the next one.
So after understanding the checkpoint of a shift to the organized market, let's move towards the next checkpoint, that is cash conversion cycle. Cash conversion cycle basically is a financial metric that measures how long it takes a company to convert its inventory and other resources into cash from sales. The cash conversion cycle is an important measure of a company's financial health in FMCG industry, where products have a shorter shelf life and a high turnover rate. The cash conversion cycle is computed by adding receivable days plus inventory days by subtracting payable days, subtracting advance from customer days, and then adding advance to supplier days. The average number of days taken by the company to collect the payment from the customers is the receivable days. The average number of days taken by the company to sell off its inventory is called the inventory days. The average number of the days taken by the company to pay the cash to their suppliers are the payable days. The average number of days for which the customer is holding the advance from customers for which they have to complete the obligations is called advance from customer days, and advance to the supplier days is for the average number of days for which the companies have paid the cash in advance to the suppliers. So the computation and calculation for these days and the whole cash conversion cycle we have shown in the Excel sheet, where we have applied the cash conversion cycle for a listed company. So a lower cash conversion cycle indicates that a company's operations can generate cash quickly, which can be used to fund the growth, pay off the debts, or distribute dividends to the shareholders. A longer cash conversion cycle, on the other hand, indicates that a company is taking longer time to convert its investment into cash and may be experiencing cash flows issue. So, as a result, FMCG companies must closely monitor their cash conversion cycle and their steps to improve it, such as better inventory management, negotiating better payment terms with the suppliers, and shortening the time it takes to collect the payment from the customers. So, let's move further towards understanding the three major components of the cash conversion cycle that are receivable days, payable days, and inventory days. Before moving further, there is a quick guide for the users who are watching our video that we have hyperlinked the data source through which we have created these charts, and our Excel sheets are also linked below the slides which we have created. So the users can access through this data and see that how we have calculated and created those charts. So let's move further for understanding the receivable days. The receivable days are basically the average time taken by the company to convert its customers into cash, that is to collect the payment from the customers. Now let us understand what is actually the significance of calculating these days. So as an individual, the receivable days helps us to understand the credit worthiness of the customer, and will also help us to know that what are the customer base of the companies. This is very important so that we can be able to know that how efficiently the company will be able to manage the cash flow. The next important point is that we can also know the effectiveness of the sales team. That is, if the receivable days are increasing, we can say that the customers are struggling to pay cash to the company, or we can also say that the company has involved in such a customer base which are not generating cash for the company. Or if these receivable days are declining, it could be like that a sales team are able to collect cash on a timely manner. Overall, the receivable days are very important metric for the FMCG companies, as it helps to monitor the receivable days and which helps us to take further steps to reduce them and improve the company's cash flow, which also helps to manage the credit risk and will lead towards the enhancement of the performance of our sales scheme. Now let's have a look at this chart which we have created. This chart is created for the receivable days for a listed company, that is Hindustan Unilever. We can see that the receivable days of the Hindustan Unilever are ranging from 11 to 15 days. We will have a further look at this data when we will share our Excel sheet for the computation of receivable days. So let's move towards the inventory days. The ratio of the inventory days tells us that the average number of days taken by the company to sell off each inventory. That means that we will be able to understand the rotation of the inventory, and will also be able to understand the consumer demand of the product. So when the inventory days are lower, we may conclude that the rotation of the inventory is fast and there is a good consumer demand which the company is catering. The products are also nice, that the demand is also maintained. So efficiently the company is able to convert its inventory into sales, which directly impacts the cash flow and profitability. When there is a high inventory conversion days, it may indicate that the company is carrying much inventory or may be experiencing the supply chain issues. That is, there may be delay in supplying the products of their goods, which may lead towards the higher working capital requirements or may generate lower cash flow and also impacts the profitability. So there may be if the company is piling up the inventory, the company wants to cater to the huge consumer demand which is coming in future. This chart is the inventory days chart of the HUL, which ranges from 27 days to 39 days. In FY15, the days of the inventory were 39 and now it has reduced to 27 days, which is actually pretty good. So now let's move towards the next days, that are payable days. Payable days basically refers to the average number of days taken by the company to pay to its suppliers for the goods or any other services they have received. Now, when you find longer payable days, there could be the reason that the company is facing cash flow issues, or the company has done certain favorable negotiated payment agreements with the suppliers, which will directly impact on the cash flow statement and will also help the company to save the cost. That is why, as payable days are subtracted from the cash conversion cycle, a company may purposefully delay the payments to the suppliers in order to reduce the cash conversion cycle if the company is the major customer of that supplier. However, the supplier should not be put on hold because our supply of the future raw materials is also dependent on him. Now, when you find shorter payable days, it is a good sign that it's showing the financial stability of the company, that is, the company is able to pay off the debt of the supplier as quickly as possible, which shows the strong cash flow of the company. However, it also means that company is not doing certain favorable and negotiated agreements for the payment with the suppliers, which will help them to save costs. So now, when we have a look at the payable days chart for the HUL, in FY 2015, the payable days were 76 days, and now in FY 22, they have reduced to 62 days.
Let's understand the next point of our checklist, which is pricing power. Pricing power refers to ability of a company to pass on the costs to consumers while maintaining its demand. It states that the consumers are willing to pay some extra money to buy your company's product. In inflationary environment, it is necessary for a company to have pricing power to maintain its profitability, as the raw materials costs are very high. So if a company has ability to pass its cost to consumers, it will maintain its profitability and market share. To judge pricing power of a company, we have to see 4 factors: EBIT margin, gross profit margin, market share growth, and revenue growth. First, what is EBIT? EBIT, it is an amount left with company after subtracting all the direct and operating costs, but not interest and taxes. What is EBIT margin? EBIT margin is the percentage of earning before interest and tax as a percentage of revenue. What is gross profit? Gross profit is the amount of money left with company after subtracting the direct costs. What is gross profit margin? Gross profit margin is the amount of gross profit as a percentage of revenue. Market share. Market share is the share of its products in market. And revenue growth. Revenue growth is the growth of revenue over a period of time. Let's take an example of HUL. In this chart, in the first chart, you can see that HUL's overall market share has increased from fiscal year 20 to 21. So it is a good sign. Let's see the calculations. I have calculated the gross profit by subtracting COGS from revenue. COGS consists of 3 items: cost of material consumed, purchase of stock in trade, and cost of changes in inventories of finished goods, stock in trade, and work in progress. So by adding these 3, you can get COGS, and gross profit can be calculated from subtracting COGS from revenue. Gross profit margins are calculated by dividing gross profit by revenue, and EBIT margins are calculated by dividing earning before interest and tax by revenue. Let's come to the chart in PPT. In this chart, we can see that gross profit margin of HUL is increasing but at a slow rate. The EBIT margins of HUL is increasing, which is a good sign, and the revenue is also increasing, so that we can say that HUL's pricing power is increasing over the years.
Let's move towards our next topic. Manufacturing efficiency means producing quality product at low cost and in a timely manner. It is about reducing waste and optimizing production to increase productivity and profitability. Improving manufacturing efficiency can help companies reduce costs, increase productivity, and remain competitive in the market. Being able to produce product quickly and at a low cost is crucial for businesses today. Companies can improve manufacturing efficiency by using lean manufacturing techniques, investing in technologies, training employees, and continuously refining process. To measure manufacturing efficiency, companies can use financial metrics such as asset turnover and EBIT growth. A high asset turnover and strong EBIT growth rate indicates that a company is operating efficiency and generating profits from its manufacturing operations. Let's move to our next topic. The asset turnover ratio is a financial ratio that measures how efficiently a company is using its asset to generate revenue. It is calculated by dividing a company's net operating revenue by its total fixed assets. The asset turnover ratio is an essential metric for investors as it helps them understand how efficiently a company is using its asset to generate revenue. A higher asset turnover ratio indicates that a company is using its assets more efficiently, while a lower asset turnover ratio indicates that the company may be facing operational inefficiencies. Let's move towards the graph of asset turnover ratio. We have computed data for HUL and Dabur from the year FY16 to FY22. Let's understand in detail for the year FY22. For the year FY22, the asset turnover ratio of HUL is 8.5 times, which means the revenue of HUL is 8.5 times of their fixed assets. EBIT growth is a measure of company's ability to increase its earning before interest and taxes over time. It reflects the company's operational efficiency and profitability. EBIT growth is calculated by comparing a company's EBIT from one period to the next. EBIT growth is an essential metric for investors as it indicates a company's ability to generate earnings before interest and taxes over time. A high EBIT growth rate indicates that a company is growing and generating more profits, which is a positive sign for investors. A low or negative EBIT growth rate may indicate that a company is facing operational challenges or declining profitability, which may be a cause of concern. So let's move towards the graph, which we will use is growth of EBIT as a percentage of revenue. Here we have computed this graph for HUL and Dabur. So on left axis, you can see EBIT is in value terms and the bar shows that value as a percentage of revenue, which will be easy to interpret the graph. Let's understand this data for the year FY22, where we can see in HUL the EBIT that is earning before interest and taxes is 22.6 of revenue, and for Dabur we can see that EBIT is 20.8% of revenue. So we can say that these companies have earning before interest and taxes around 20 to 23% of their revenue. Let's move to our next topic. Distributor efficiency refers to the ability of a distributor to effectively and efficiently get products from manufacturers or suppliers to retailers or end consumers. Efficient distributors are able to generate high revenue per distributor by effectively reaching their target market and making sales. This not only benefits the distributor but also the company that they are working with by generating revenue and increasing market share. One way to measure distributor efficiency is by analyzing the revenue per distributor. This metric measures the revenue generated by a distributor as a result of their efforts over the time. Inefficient distributor may struggle to generate revenue and have a low revenue per distributor. To improve distributor efficiency, companies should provide support and resources to help distributor improve their performance. Analyzing revenue per distributor helps identify efficient and inefficient distributors and support improving their performance. By doing so, companies can increase their revenue and profitability, strengthen their relationship with customers, and gain a competitive advantage in their market. The formula for distributor efficiency is revenue from operations divided by total number of distributors. The above graph shows the revenue per distributor of HUL and Dabur. We have collected this data from their annual reports.
Brand extension means under the same brand how many category of product you are expanding. This strategy is often used to leverage the brand equity and expand the product offering of particular company. Brand extension should be done very carefully. Like Dove is in the beauty and personal care segment. The Dove can expand in beauty and personal care segment, but they cannot launch a food product under the name of brand Dove. Consumer will not buy that product. All right, like brand extension should be done very carefully, and uh, otherwise it will destroy the brand reputation and erode consumer satisfaction, consumer trust, etc. Dove is the best example of brand extension. Basically, Dove was started with the soap category. From soap category, it had built a consumer association, a reputation among consumer satisfaction. So they had expand from soap to the hair care and beauty product. Now the Dove is providing ranges of product in soaps, beauty product, hair care product. Brand extension should be done in relevant category. It should not be done in irrelevant category. Otherwise, it will affect the brand reputation which has built over the year.
So now moving on to the next point of our checklist, it's misallocation of capital. This is actually one of the most important points of this checklist. So let's get started with what does it mean. So as I've written here, the meaning of misallocation of capital is the inefficient allocation of financial resources in a manner that fails to maximize value creation for the business or investment portfolio. Now let's see what are its effects on the business. It can result in a range of negative outcomes, including reduced profitability, increased financial risk, diminished competitiveness, and missed opportunities for growth and expansions. Now let's take a look at what causes capital misallocation. It can occur due to a range of factors such as poor decision making, inadequate due diligence, lack of market insight, and unforeseen changes in market conditions. Now, what are the measures to be taken for avoiding misallocation of capital? Companies need to undertake a rigorous analysis of expected returns, risk, market trends, and competition, and aligning investment decisions with the overall business strategy or investment objectives. Now, to understand misallocation of capital in a better way, we have prepared a case study. Okay, so let's start with a case study for misallocation of capital. And in front of us, we have ITC business. And what I've done here is I have punched the segmental level data of ITC, which is sourced from its annual reports itself. So what I've done is I have punched the data from the years 2013 to 2022, which is a 10-year horizon. Let's start with the segmental revenue. So what are we gonna do today is look at the hotels segment of ITC business and how it has performed over the last 10 years. So let's take a look at revenue. So this is its revenue increasing at a CAGR, which is a compounded annual growth rate of 2%. This is how CAGR is calculated using the rate formula, growing at a rate of 2%. Then this is common sized revenue. Common sized is basically revenue of hotel segment compared to its total revenue. So the hotel segment contributes to around, at an average, we just take this average, and if you can see here, the average is 3%. So the hotel segment contributes around 3%, only 3% of the company's total revenue. Moving on, I have punched segmental results. The results are nothing but EBIT, which is earnings before interest and tax. So let's take a look at it. So these are its EBIT numbers over the years. They have decreased in the recent 2 years. And let's take a look at their EBIT contribution in the overall EBIT. It's at an average of 0%. So over the last 10 years, the segmental EBIT of hotel segment, sorry, I'll correct myself. The hotel segment has contributed to at an average of 0% to the company's total EBIT. Moving on to operating profit margins. The operating profit margins are nothing but the segmental EBIT upon segmental revenue. So let's take an average of this. So they are growing at an average of -3% over the last 10 years. Now let's take a look at segmental assets / capital employed. So what we have done here is we have punched the segmental assets data for hotel, and it has been on a growing scale in the last 10 years. And we have also calculated incremental capex. Incremental capex is nothing but current year's asset minus previous year's assets. they are at a cumulative number of 3,000 crores compared to the total incremental capex of 18,500 crores. So if we do a common size here, this upon total, so it's around 17%. Next up, we have segmental capex, that is capital expenditure. Now we can see that the capex numbers, let's compare them to the overall capex the company has been doing by common sizing. So let's do this once this for. Now let's take an average. So the average of 26%. So 26% of total capex is invested in the hotel segment over the years. So what we can conclude through this case study is the company has been constantly allocating capital in this segment at an average of around 26% on a 10-year horizon, which provides them an asset turnover of 0.2, which is the lowest in every segment they operate in. Then they provide they contribute, this segment contribute to an average of 0% of its operating profits and contributes to an average of 3% of its total revenue. So so we can conclude that there has been a huge misallocation of capital in the ITC business over the last 10 years in the hotel segment.
Relative price index. Before jumping into relative price index, I will tell you an amazing fact about Clinic Plus. Clinic Plus has more than 255 million household consumption in India. What are reasons for that? At the end of the slide, you will get a reason for it. So let's jump to the relative price index. Relative price index is a measure used to compare the price of basket of products. Relative price index is a strategy used at the time of pricing of a product. In this chart, we have highlighted the average pack size, which is the average pack size of the 4 brands Clinic Plus, Pantene, Head & Shoulder, and Dove. We have taken the average pack size from 5.62 ml to 1 liter, and we have computed average price, which is average of these 4. All right. We can easily see that the average per Clinic Plus has a lower price compared to the average price in other 3 brands. What it shows? It shows that Clinic Plus has used the relative price index strategy very efficiently and priced their product less compared to the average shampoo product sold in India. So that's why India is a developing country. Majority of population lives in the rural area and use product which are comparatively cheap. They need a shampoo to only remove the oil in their hair, not for the conditioning element. So Clinic Plus has used that strategy by consumer observation and price their product comparatively at less price to the average price of the shampoos and other brands shown here.
Next up, we'll be looking at 2 financial ratios known as ROCE and ROIC. So let's get started with ROCE first. ROCE stands for Return on Capital Employed. It is basically a financial metric used to measure the profitability and efficiency of companies' investments in capital. ROCE is calculated by NOPAT, which is net operating profit after tax upon debt plus equity, which is the total capital employed. Now moving on to the graph, what we have done here is this is Godrej Consumer Limited, and we have plotted ROCE numbers from FY18 to FY22 according to the industry in comparison with the industry average. Next up, we have ROIC, which stands for Return on Invested Capital. So ROIC is a financial metric that measures the amount of return a company generates from the capital it has invested in its business. ROIC is calculated by NOPAT, again NOPAT, which is net operating profit after tax upon invested capital. And what does invested capital include? So invested capital includes all the capital a company has used to fund its operations, such as fixed assets and working capital. So this is the formula for ROIC, which is EBIT into 1 minus tax rate upon invested capital. And this is the formula for ROCE, which is EBIT into 1 minus tax rate upon total capital employed. So let's take a look at the case study. So let's get started with the case study. So we will first start off with ROIC, computing ROIC for Godrej Consumer Limited. So what we have done here is we have punched the data from the company's annual reports, which are available on the company's website and also on Bombay Stock Exchange's website. So first we have punched fixed assets, which includes property, plants, and equipments. Then intangible assets, and then goodwill. Next up, we have receivables, then inventories, payables, advance paid to suppliers, advance from customers. Next up, we have borrowings, which include current as well as non-current borrowings. Next up, we have the total equity. Then we have EBIT, which is earnings before tax. Then we have the tax expenses. I'll correct myself. Interest expenses. Then we have EBIT, which stands for earnings before interest and tax. Then we have punched the data of tax expenses from the profit and loss statement, and then we have calculated tax as a percentage of EBIT. Next up, to summarize all of these line items, we have calculated assets by summing up these three line items, which are fixed asset, intangible assets, and goodwill. Next up, we have calculated working capital, which is receivables plus inventories minus payables plus advance from customers minus advance paid to suppliers. Next up, we calculated invested capital by summing up these two line items, assets and working capital. Then net operating profit after tax by EBIT into 1 minus tax rate. Now you may ask that how are the EBIT and the EBIT numbers the one and the same? So a point to be noted here is in ROCE and ROIC, we assume that our borrowings, that is our debt, is our equity, which means there's no differentiation between borrowings, that is debt, and equity. So it results in the interest expenses getting added back to the EBIT to the EBIT number, which makes the EBIT and the EBIT numbers the one and the same. Okay, so there might be another doubt that why are intangible assets and goodwill considered in core business investments? So basically, here in this case, the intangible assets and goodwill accounted for more than 5% of the company's total assets. Here, the intangible assets accounted for around 15% of the total assets, whereas goodwill accounted for 30% of company's total assets. So here, it can be concluded that intangible assets and goodwill plays an important role in the revenue generation of this company. So next up, to conclude this, how we calculated ROIC is by dividing net operating profit after tax by invested capital. So what happens if we ignore intangible assets and goodwill while accounting for ROIC of Godrej Consumer Products? So let's take a look at this. Now let's take a look at how this change of not considering intangible assets and goodwill in companies' invested capital changed the ROIC. We can conclude that the ROIC has shot up tremendously because the denominator, which is the invested capital, got lessened as we didn't consider goodwill and intangible assets. Now let's move on to computing ROCE. So everything we have done till now in ROIC stays the same. It stays the same, and it follows the same procedure to calculate ROCE as we did for ROIC. So the assumption that the borrowings are considered as equity stays the same. The interest expense get added back to the EBIT, making EBIT numbers and EBIT numbers the one and the same. The numerator for calculating ROCE and ROIC, which is NOPAT, also stays the same. As we can see, these numbers are one and the same. So how does ROCE differentiates itself from ROIC? The answer is the denominator. For calculating ROCE, we take NOPAT upon debt capital employed, which is debt plus equity. So as you can see, these are the figures from FY18 to FY22, ROCE figures of Godrej Consumer Limited, and this is the graph that we first saw in the presentation. So I hope ROCE and ROIC computation is clear, and let's move on to our next topic. Okay, so now that we have understood ROCE and ROIC ratios, we can move on to knowing what do they actually convey. The higher the ROCE and ROIC ratios, we can conclude that the company is more efficient to generate profits through the capital it has invested. And the lower the ROCE and ROIC ratio, we can conclude that the company may be less efficient in generating profits from the capital it has invested. And what is its significance for investors as well as analysts? So for ROCE, it is a useful metric for investors and analysts because it helps them evaluate how effectively a company is utilizing its capital to generate profits. Whereas for ROIC, which is an important metric for investors because it measures a company's ability to generate profits from the capital it has invested. So that was it for ROCE and ROIC ratios.